Hello and welcome back to Real Estate Agent School. My name is Cameron Ura. I am a full-time real estate agent and real estate coach, helping agents any stage of their career go from struggling to successful or successful to absolutely crushing their career in real estate. In this video, I'm going to share with you how you can help sellers right now with higher interest rates still succeed by saving money in the market. I know this is a crazy common question and a real struggle for real estate agents right now, trying to help their clients, trying to get new business when the main objection is interest rates are so high, I can't even do anything. Hopefully this video will help you, and hopefully if you stay to the end, you'll know exactly how to talk your client through this scenario and share with them how you can help them save money. So I recently got this question from a student in the Real Estate Agent School membership, and he was wondering how to help his clients save money even with interest rates being so high and when selling, taking a hit because the market is lower. In this scenario, I'm going to go over the numbers. I'm going to break down exactly how I would do this and how it looks on the whiteboard. I'm going to draw it out for you and answer all of your questions. So stay tuned for this entire video, and I hope you learned something. If you have questions or if you don't understand something, please leave them in the comments. I'm happy to make follow-up videos to this one because I know this is a complex topic and strategy to help your clients succeed. Okay, so this is pretty much the only way I figured out how to make this actually work on a video. So if you have a better way to make a higher quality drawing or writing videos, leave it in the comments so I can make these videos better in the future. But for this example, we're going to be talking about a townhome that is worth $425,000 right now. And that's what it's currently being sold for. This townhome has roughly $100,000 in equity, and their current payment a month is $1,600. The two scenarios we're going to talk about is using their entire equity and then equity alternatives. What I mean by this is instead of using their entire equity, only putting 5% down and then using the rest for debt and other things like that. So we'll go over both scenarios, and this is what you'll be doing with your seller to help provide value and explain what is possible when going through the different scenarios of high interest rates and how to leverage their equity. So for example, say they were to put $100,000 down on a new home. For example, their home that they want to get is $669,000. Their monthly payment on this would be $4,224 roughly. This is at a 7.5% interest rate. Now, for example, here, 5% interest, that is roughly $32,000, or not 5% interest, I apologize, 5% down payment. This brings their payment to $4,746 per month. So obviously this is a massive change from $1,600 to upwards of $4,746 a month. That is a very hard sales pitch for practically anyone when looking to sell and buy a new home. If most homeowners are looking at this being like, yeah, I don't know how I would ever figure out how to buy another home if my payment was going to go up that much. But in this scenario, I'm going to teach you how to actually overcome this and pitch this in a better way. So for example, I want to touch on the equity alternatives first. Say this person has car payments and that totals $1,000 a month, and that equals roughly $50,000. Say they have two cars and they have about $50,000 in outstanding debt on those. Say they also have credit cards and they have roughly $500 a month in payments on credit cards. This is now $10,000 in outstanding debt. And then they have student loans, and this is $200 roughly, and they have $30,000 of this. So between all of these, they have an additional $1,700 a month that they are paying on top of their mortgage, which now equals $3,100 in monthly expenses. So $3,100 to $4,700 is not that big of a gap, still a pretty large gap, but we'll cover that in a second. So for example, The reason why I talk about this is if you're able to pay off some of these, let's take the car and the credit cards, because that is the highest leveraged credit. You're now freeing up $1,500 in extra income that they can use for their future mortgage. And the reason why you do this is because you're taking $60,000 of their equity plus their down payment of $32,000, and you're now left with $8,000 from the $100,000 that they got from selling their home. So obviously you're saying, hey, they're still going to have closing costs, yada, yada, yada. But in this scenario, with how the market is, we're actually hoping to get $15,000 off of the purchase price plus 3% towards closing costs paid by the seller. So when we plug this into our scenario, this now totals out to be roughly $30,000. Oh, sorry. We'll make sure you guys can see this. $30,000 in added benefit from buying something sooner rather than later. So to bring this all together so it makes sense, because you're probably thinking like, where are you even going with this right now? You have effectively been able to create $30,000 in value from their purchase. You've also freed up $1,500 in more income technically. So now the difference between the $3,100, this number right here, and what they're going to be paying, the $4740 roughly, is really only $1,600 or so, $1,600 a month difference. And so if we were to take $30,000 of what they were saving from getting into a home sooner, dividing that by 1,600, it would take 20 months to break even. So they wouldn't be losing money, or it wouldn't be more expensive technically for them to do this scenario for 20 months. And prior to this, they would be refinancing. Okay. Hopefully this makes sense. Again, if you need another video, if you want me to explain it in a different way, I'm happy to. I'm going to break this down a lot more so it makes more sense. But to recap, they first need to be able to be approved for this. Obviously, sometimes that's not going to be possible. And if that's the case, you're going to build an awesome relationship with them, provide a ton of value like you're doing right now, and wait until the time is right for rates to come down. And then you're going to have to figure out another scenario when that does come. But if they can be approved for this, they are going to save money because of the 20 months prior to refinancing, as well as some of the things I'll talk about here in a second with this scenario. So you're paying off debt, putting $8,000 into their savings or whatever they want to do with that, and they're into the nicer, newer home that they want to buy sooner rather than later. Now, coming back over here to if they were just to put it towards their equity and just put their equity towards the new home, their payment would be lower. And so none of this over here would apply with paying off debt or anything like that. But they would have about 13 months of savings from all of this scenario over here, from the $15,000 off the purchase price and 3% in closing costs, before they would be losing money. The way this works is their $4,224 payment subtracted from their previous payment of $1,600 is about $2,600 in difference. This then divided by the $30,000 in savings from this scenario right here is about 13 months of savings, which is prior to another refinance. So I'm going to flip this over and we're going to jump back into what this now can look like with a refinance. So if this home were to be refinanced with the $690,000 or $669,000 purchase price at 5% down, that new payment would be $3,100 a month. So what's crazy about this is that is the exact number of what they were previously paying. Geez, I cannot write. Previously paying for their mortgage and other debt. So that was their mortgage plus debt. The crazy part is they bought a $669,000 house, which with 10% appreciation just made them $70,000 of appreciation in a year. This could be, if they went the whole 20 months prior to refinancing, would be even more than that if rates were to come down and things were to get more expensive. Because when rates do come down, prices go up. That's just how it happens. And so on the other scenario, if they were to stay in their home at 10% interest or appreciation, that would only be $40,000 roughly. So this is a $30,000, I don't know why I keep drawing that zero, $30,000 gain from appreciation just by buying the other home, on top of now having debt paid off, having the same exact expenses. And so not only are they saving money from a bidding war standpoint, they've also made an extra $30,000 in appreciation, and their payment is exactly the same as it previously was with their debt. So hopefully this makes sense with how you can restructure somebody's payments using their equity, using appreciation, even with higher interest rates, and with the potential to refinance in the future, because we will be able to refinance. It's just depending on when. And if you can explain this to a client, they can afford the new payment, it will make sense in the future. So after that explanation, you're probably not understanding very well, because I didn't explain it very well. I'm looking for a better way to write that out other than on a piece of paper with a really bad video quality. But the premise still stands that if you can restructure your client's debt, you can explain how a refinance could help them in the future, as well as leveraging their equity to help them understand that even though interest rates are higher right now, you can get the home for less, and you can leverage that for your savings in the future. You can help clients save even though interest rates are higher. So what I will say is this isn't going to be for everybody. Not everybody can be approved for that higher payment. Not everybody is going to want to move. Not everybody is comfortable with that higher payment. And not everybody wants to bank on appreciation. And so the value in this strategy is the fact that you are going to be an incredible professional when you explain this to somebody, where you will earn their business down the road if you can understand that, hey, I'm not going to win everybody over. I'm not going to force anybody to sell. Instead, I'm just going to educate, explain, and follow up and be that market expert for when the time is right. So use this strategy. If you have questions, if you want another video, a part 2, whatever you need, leave it in the comments, and I hope you have success with this strategy in the future, and I'll see you in the next video.